Buying a home is one of the biggest financial decisions most people will ever make. But what often gets overlooked is how that decision affects everything else in your financial life. A lot of people feel like they're stuck choosing between two bad options. Either sell investments they've worked for years to build just to fund a down payment, or they stretch themselves into a mortgage structure that doesn't really fit their financial plan. The good news is that those are not your only two choices. Today, we're going to talk about several lesser known mortgage strategies that can help you buy a home without derailing your broader financial plan. I'm Justin Kuntz, Managing Director of Pacific Wealth Management, helping you make good financial decisions through sound management for a secure future. Let's start with one of the biggest misconceptions when it comes to buying a home. A lot of buyers assume that they need to sell stocks, bonds, or other investments to come up with a down payment. They feel like staying invested and buying a home are mutually exclusive goals. However, in practice, that's not often the case. If you've spent years building an investment portfolio, liquidating a large portion at once can have significant ripple effects. You can trigger capital gains taxes, miss out on future market growth, and even the role those assets were meant to play in your long-term plan. That's why it's so important to understand what alternatives actually exist before committing to a traditional mortgage structure that you hear so much about. One option that can be especially powerful is buying your next home without waiting to sell your current one. Most people are familiar with bridge loans, which are designed to help you temporarily carry two homes at once. The problem is that bridge loans often come with high interest rates, typically in the 8.5% to 10% range in this market, plus points and fees that can quickly make them really expensive. A lesser known and more efficient alternative allows some qualified buyers to move forward with a loan as if their existing home were already sold. In practice, this means that the lender underwrites the new purchase assuming the equity from your current home is available, even though the sale hasn't happened yet. That allows you to make the offer without a sale contingency, which sellers tend to prefer. It removes the pressure to rush to sell your current home, and it typically comes with a standard mortgage pricing model rather than the expensive bridge loan terms. For buyers who are upgrading, downsizing, or relocating, this approach can create a level of flexibility that's difficult to replicate with traditional financing methods. Another powerful strategy involves using assets to boost borrowing power without selling those assets. This option can be especially helpful for retirees, pre-retirees, or anyone whose financial strength is tied more to current investments than current income. Traditional mortgages rely heavily on monthly income, but many financially strong buyers don't show high income on paper, even though they have substantial assets in the bank. As a result, they can appear less qualified than they actually are. Asset-based or asset depletion mortgages are designed to solve that problem by converting a portion of your assets into qualifying income. For example, some programs calculate just under $12,000 per month of qualifying income for every $1 million of eligible assets. That income can then be used to qualify for a mortgage, even if your tax return shows just modest earnings. The key benefit here is that you don't have to sell investments to make it work. That means no forced capital gains, no tapping retirement accounts prematurely, and no unnecessary disruption to your long-term investment strategy. A third strategy, particularly relevant for business owners and self-employed buyers, involves using bank statement loans. If you own a business, you already know that tax returns don't always reflect your real financial strength. Many owners reduce taxable income through deductions, depreciation, and other write-offs. From a tax perspective, that's smart, but from a mortgage perspective, it can make qualifying unnecessarily difficult. Instead of relying on tax returns, bank statement loans look at 12 months of business bank statements. The lender totals the deposits, averages them, and applies a standard expense factor to estimate income. Typically, that expense factor is around 50%, but if your CPA can verify your business operates more efficiently than that, some lenders will use a lower expense ratio, allowing more of your real cash flow to count towards qualification. What makes this option especially interesting is that the rate difference compared to traditional loans is usually minimal, sometimes around 0.12% higher. For many self-employed buyers, that small trade-off is well worth the flexibility that it provides. What's important to remember and understand is that these strategies are not mutually exclusive. In many cases, they can be combined. A self-employed buyer might use bank statements to qualify, asset depletion to strengthen the buying power, and a no-sale contingency structure to buy before selling their current home. The right approach depends on entirely your personal circumstances, your tax situation, and your long-term financial goals. The main takeaway here is that buying a home shouldn't force you to unnecessarily compromise. There are more tools available than most buyers even realize, and the key is asking the right questions, early on and working with professionals who think beyond the standard playbook. When your home purchase is coordinated with your broader financial strategy, it should enhance your financial security, not disrupt the plan you've already built. I'm Justin Kuntz, Managing Director of Pacific Wealth Management, and if you want to make sure that your home purchase is working within the boundaries of your financial plan and enhancing that plan, take a look at our website, www.pacwealth.com, and check out our other videos. Thanks.